Welcome back to Financial Literacy for Lawyers, Bridging Law and Business. I'm Professor Seth C. Oranburg, and this episode explores the crucial connection between financial literacy and fiduciary duties of directors and board members. We'll discuss how understanding financial statements is more than an administrative task. It's core to meeting legal duties, managing risk, and making informed decisions. So even if boardrooms feel distant, these principles apply to any advisory role, from counseling executives to serving on nonprofit boards. And if you do spend time in boardrooms or with executives, this is a crucial conversation where you'll become more familiar and more comfortable talking numbers with folks who use that as their lingua franca. If you're applying these concepts to your own practice, remember, we should start with the basics covered in episode 3 through 6, where we talked about the 3 different financial statements and then integrating them. And remember, this is an educational podcast for legal or financial advice. Consult a professional. So let's talk about oversight in action. Directors and officers are fiduciaries, meaning they must act in the best interest of the corporation and its stockholders, which are its owners, and not for their personal gain. And they may even have duties to other stakeholders in certain cases where there's insolvency. There are 2, or depending on who you ask, 3 core duties from this foundation. The first is the duty of care. Directors must stay informed, ask questions, and make careful, educated decisions. Think of it as the due diligence standard applied to board actions, and this ensures choices are based on reasonable information. The second is the duty of loyalty. This mandate means undivided allegiance to the entity, requiring directors to avoid conflicts of interest, to act with integrity, to disclose personal dealings that could influence both, and not to enrich themselves at the business's expense. And the third, which could be seen as derivative of the 2, is the duty of obedience. Now, it has a special meaning in nonprofits where there's a duty of obedience to the mission, but there may be, as some perceive it, a duty of obedience to the corporate documents and to the law. Neglecting these duties can result in personal liability, lawsuits, or regulatory action. For example, in the 2018 Uber data breach settlement, the company paid $148 million across 50 states for failing to disclose a hack affecting 57 million users, with board oversight being questioned and related probes over whether directors adequately monitored cybersecurity risk. Financial statements are a primary source of information for fulfilling these duties because they transform abstract obligations into a concrete way to review the financial health of the business and to engage in compliance. So, the key thing is that active engagement is required. You can't just let the business run its course. At the heart of the duty of care is financial oversight. Directors must actively review and understand the financial status of the organization through regular examination of balance sheets, income statements, and cash flow reports. This is not just for large corporations. Every board member, regardless of background, is expected to develop enough financial literacy to judge the health of the organization, to ask probing questions about variances, about expenses, about reserves, and to monitor future trends against budgets. And yes, this even applies to nonprofit board members. So if you are serving on a charitable board, you do have obligations to have this level of financial literacy. Failure to monitor finances can be seen as a breach of the duty of care, especially if problems go undetected or are ignored. It's like a lawyer skipping due diligence in a deal. You can't claim competence if you didn't read the core documents. The Caremark doctrine from a landmark Delaware case in '96 emphasizes that boards must have systems to detect and address red flags, and financials are at the center of that dashboard. Failure to oversee can lead to liability if harm results from inaction. In practice, this means directors aren't passive. They must engage. For example, if cash flow is negative despite positive earnings, questioning management isn't optional. It's required to avoid personal liability. And it could indicate underlying issues like poor collections needing board intervention. Directors who disregard financial warning signs, such as persistent losses eroding equity, negative working capital signaling short-term cash shortages, or unexplained transactions, hinting at self-dealing, may be personally liable for failing to act prudently. If a company becomes insolvent, directors may have heightened duties to creditors and are expected to adjust operations or seek professional advice. Continuing to incur debts, distribute assets, or misrepresent finances when insolvency looms can trigger personal exposure under doctrines like deepening insolvency, at least in some jurisdictions that hold that doctrine. Where worsening the financial hole harms creditors, the creditors might be able to sue the director. High-profile cases illustrate the stakes. In the Boeing 737 MAX crisis, which spanned from 2019 to present, oversight failures in monitoring safety and financial risks from production led to severe penalties. In May 2025, Boeing agreed to a $1.1 billion settlement with the Department of Justice to avoid prosecution over the crashes, including compensation for victims' families, amid ongoing litigation where directors face scrutiny for ignoring warning signs and reports. The two crashes in 2018 and 2019 killed 346 people. It grounded the fleet for 20 months, and it cost Boeing over $20 billion in total, with the settlement including $243.6 million in criminal penalties and a requirement to have an independent compliance monitor. Here's another example. In Marchand versus Barnhill, the 2019 Bluebell case, the Bluebell Creamery's board members failed to monitor food safety risks despite red flags and operational reports, leading to a listeria outbreak and a Delaware Supreme Court ruling that allowed claims for breach of duty of care to proceed. The outbreak killed 3 people and sickened dozens, forcing a nationwide recall and halting production, with the court reversing dismissal to emphasize board's oversight obligations under Caremark. This underscores that blind spots turn into oversights, turn into breaches, turn into liabilities that can result in the end of a business. So what are some tools and best practices for boards? Fulfilling these obligations requires practical engagement and tools tailored for boards, making monitoring systematic rather than sporadic. The first is to attend and participate in board meetings where finances are discussed, which ensures dedicated time for questions and debate. The second is to regularly review and question financial statements. If you're unsure, ask for clarification or simplified dashboards that visualize key metrics. The third is to compare financial results against budgets and projections to try to spot anomalies, like using ratios like debt to equity to gauge leverage risks. The fourth is to insist on transparent policies for cash handling, expense approvals, and conflicts of interest, aligning with frameworks like the COSO internal controls, which provide standards for reliable reporting. The fifth is to review independent audits and address any reported concerns or material weaknesses promptly. Treat them all like early warnings. Directors should not delegate all financial review to staff or advisors or accountants. The law requires active, personal involvement to satisfy Caremark. So directors and their lawyers can build confidence by starting with one key metric per meeting, like looking at cash runway, which is how long cash lasts at the current burn rate, and then building to that to make oversight manageable and focused. In the next episode, we pivot to transactions and deal-making, revealing how financial statement analysis underpins mergers and acquisitions and major contracts, and how legal and financial professionals collaborate to spot risks and structure successful deals. To apply this in the boardroom, here's a straightforward playbook with details to implement effectively. The first is seek out the basic financial training as part of board onboarding. This lecture is somewhat helpful, but if you're getting into a board of directors level position, you probably want some practice with actually doing some of the ratio analysis and working through some of the math. There are many CLE programs that offer director-focused sessions on reading statements and spotting risks, and you might want to get an online course like Coursera that's more dedicated on doing the accounting ratio analysis, but you would be looking for something in the area of financial analysis where you actually practice doing the ratios. The second would be build a checklist of key questions for each financial report. So, for example, are cash flows sufficient to cover operations? Are expenses rising faster than revenue, which would indicate inefficiency? Are there unexplained liabilities that could be contingencies? The third step is to ensure minutes of board discussions reflect meaningful discussion and review of finances, not just formal approvals. This documentation is a shield in litigation because you have to have due diligence, otherwise, you've failed the duty of care. The fourth is to regularly update and review the organization's risk management and internal control policies by incorporating financial metrics like liquidity ratios. The fifth is, when in doubt, disclose conflicts and recuse yourself from financial discussions to preserve loyalty and avoid challenges to the duty of loyalty. Transparency here prevents invalidation of decisions and liability for you. Fiduciary duties and finances aren't separate. They're intertwined for effective business governance. And I hope you're more equipped to engage with them more fully now. We'll continue building your skills in the next episode. But until then, I'm Professor Seth C. Orenberg, and this has been Organized.